In this segment, we're going to talk about an adjustable rate mortgage, also known as an ARM, adjustable rate mortgage. I am going to show you some of the features in an adjustable rate mortgage, and I am going to show you how to calculate the rate on an adjustable rate mortgage. First, with an adjustable rate mortgage, we're going to have something called the margin. The margin is the money that the banks or the lending institutions make for servicing the loan throughout the course of the loan. The thing you need to know about the margin is this. The margin is always fixed. The margin can never change. It must remain fixed once it's established by the lender. So the lender can never go back in and revise the margin. The margin is going to always remain the same throughout the term of the loan. Now, ARMs also allow for interest rate adjustments that are tied to independent indexes. And an independent index is an indicator of current market conditions, and it is used to calculate the mortgage rate. Now, there are several different indexes that are out there that a lender can use. One of the indexes is the T-bill, the one-year T-bill. Another one is the LIBOR index, the London Interbank Offer Rate. And then we have the COFFEE index, the Cost of Funds index. Now, there are three things you need to know about indexes whenever a lending institution is choosing to use an index. Number one, the index must be beyond the lender's control, meaning that the lender cannot use their own index in the note. No, it must be beyond the lender's control. Number two, it must be easily verifiable, meaning that the public could go and pull up the information in a newspaper or on the internet. And the third thing is the index that the lender starts off with must never change. For example, if a lender starts off using the COFFEE index, they cannot later go and decide to use the LIBOR index. The only time a lender can change the index that they're using is if the index is no longer available and the index is no longer published, and even then they must make sure that the index company that they choose to switch to must have the same tendencies as the prior index that they use. So let's look at the rate. How do you calculate the rate? We add the margin plus the index is going to equal your rate or your start rate. So for this example, the margin is 3%. The index is 4%. So the start rate is going to be 7%. That's how you calculate a rate on an adjustable rate mortgage. Now, there's some other features you need to know about an adjustable rate mortgage, though. An adjustable rate mortgage has something called a cap rate. A cap rate. They have a lifetime cap rate and an annual cap rate. And the cap rate lets the individuals and the parties who are participating in the note know how much the rate can go up at any one given time. Now, the lifetime cap rate would mean the most that the rate can ever go up over the lifetime of the loan. And in this case, for example, we're using a 6% lifetime cap rate. So if we use this example, the most this rate can ever go up is 7% plus 6%, and that's going to turn out to be 13%. So we'll take the 7 plus the 6, and that'll equal 13%. That's the most this person's rate can ever go up over the course of the entire loan period. Now, the annual cap rate is the most that the rate can go up in any one given year. So if they have an annual cap rate of 1%, the most this rate can ever go up in one given year would be to 8%. And then the next year, if it's at 8% and the rates fluctuate because the index change, It can only go up 1% that year. So those are the features in an adjustable rate mortgage. Now, a lot of people panic. They panic when they find out that they have an adjustable rate mortgage, but they shouldn't, because there are several disclosures that one must sign notifying them that they do have an adjustable rate mortgage. And one of the documents is the Truth in Lending document, also known as the TIL. So if you're not for sure if you have an adjustable rate mortgage, go to your closing documents that you received at your title company. At the very top of one of those forms, it's going to say Truth in Lending. Truth in Lending, also known as the TIL. Go to the middle section of that TIL and you will see if there's a box that's checked by adjustable rate feature, it means that you have an adjustable rate mortgage. Now, I've just went over with you the features in an adjustable rate mortgage, and I've shown you about the margin, the index, and how to calculate your rate. And I've also explained to you the cap rate, the most the lender can go up on a rate over the lifetime of the loan, and the annual cap rate. Nowadays, most lenders, what they're doing is they're qualifying people based on what we call the worst case scenario. They're taking the start rate plus the lifetime cap rate, which is 13% in this example, and this is the number that they're using to qualify people to buy their homes. And I think this is very wise, because if a person cannot afford to make the payments now, estimating the maximum cap rate plus the current rate, they won't be able to afford it in the future, even if they start off at the low rate and it begins to adjust. So I think that it's something that the lenders are doing across the country, and I strongly believe that if you're going to provide a client with an adjustable rate mortgage, make sure you provide them with a worst case scenario.